What if I told you that the single easiest investing trick in the world, one that doesn't require timing, predictions, or even luck, is the same strategy that made me rich? It's called dollar cost averaging. And in this video, I'm going to show you exactly how it works, why it beats most investors, and how you can start today, even with just a few dollars. Now, the problem with timing the market. Here's the reality. Most people lose money because they try to time the market. They wait for the perfect dip, they panic when prices fall, or they chase hype when prices rise. But even professional investors can get the timing wrong. There's a famous study that showed if you missed just the 10 best days in the market over 20 years, your returns would be cut in half. Think about that. 20 years of investing destroyed because you missed 10 good days. That's why guessing the right moment almost never works. I'm going to show you here in this video, guys, why dollar cost averaging really works and has helped me amass a lot of wealth through simply not timing the market. Now, what is dollar cost averaging? Dollar cost averaging flips the game. Instead of stressing about when to buy, you invest a fixed amount of money on a set schedule, daily, weekly, or even monthly. When the market is high, your money buys fewer shares. When the market crashes, that same money buys more shares. Over time, you smooth out the ups and downs and keep growing your portfolio without the emotional roller coaster. Let's say you invest $10 a day into the S&P 500. That's it. You just need $10, less than the cost of a fast food meal for most people. When stocks are expensive, your $10 buys you a little. When stocks are cheap, your $10 scoops up a lot more. Fast forward and you built up a portfolio that keeps growing whether the market is booming or crashing. That's the magic of this consistent gain. Now let's look at some real numbers. If you had invested $10 a day for the past 10 years, you'd have put in around $36,000. But today that would be worth over $60,000. That's nearly doubling your money without even over trying to predict a dip or worrying about when to buy. Compare that to someone who dumped all their money in at the peak before a crash. They'd spend years just trying to break even. With dollar cost averaging, the crash becomes your best friend. That's basically when you're buying more at a discounted price. Now on screen you can see we have the S&P 500. There's several crashes that have happened in the last mini crashes, I would say, in the last 3 years, 4 years. One being COVID, which you could see here in 2020. So if you had bought at the top of these markets, you could see how it would take you a lot longer to recuperate the losses. For instance, here, if you had bought at the top of the market here, which was in January 2022, it would have taken you roughly 2 years, longer than 2 years, to recoup those losses, which is a significant amount of time and a lot of time holding potential losses. However, on the other hand, if you had bought on the average, and this is the weekly chart we're seeing here. So if you, for instance, bought on a weekly basis, right, your average price would be a lot lower compared to buying at the top here, which is $478. Your average would be as low as, in the range of $300 to $350, meaning that once you do get to that point where it is breaking even in December 2023, you would have actually ended up with a profit at that period in time had you implemented this strategy. Now, why does this work, right? The secret isn't just the maths, it's also psychology. Most investors get wrecked because they panic. When markets fall, they sell at a loss. When markets soar, they buy at the top out of fear of missing out. Dollar cost averaging removes emotion completely out of the equation. You stick to the system no matter what, and that's when compounding takes over. For instance, Albert Einstein called compound interest the eighth wonder of the world for a reason. The longer you stay invested, the faster your money grows, and dollar cost averaging makes sure you never miss out. And I believe with the stock market, being highly unpredictable, it takes all the emotion away from your trading, from your mindset, and how you approach the market. So the question might come up as to who should use dollar cost averaging. So Honestly, it can be almost everyone. Whether you've got $50 a week or $500 a month, dollar cost averaging works the same. And it's not just for beginners. Many millionaires and professional investors use this exact approach with index funds or ETFs because they know the truth. Consistency beats prediction. Now, what are the practical steps to get started? So, how really step one is pick a low cost index fund or ETF, right? A good example of that is like the S&P 500. Step two, set up automatic contributions. Weekly or monthly works best. Step three, you just simply leave it alone. Don't cancel it during a crash. Don't chase other investments because they look better. Just let time and compounding do the heavy lifting. I'm going to actually go through another example like Bitcoin. A lot of you are invested in cryptocurrency. Bitcoin is another example with huge swings over the last few years. This shows how dollar cost averaging would have worked best than buying at the peaks of the market, right? And we know Bitcoin is highly cyclical. It's shown huge waves over the years, and buying at the highs would have meant that you would have had to wait a long, long time. For instance, in November 21, a previous peak here at $67,000 would have taken, that's 3 years essentially, almost 3 years to break even, right? So you can see how this would work best. And if you had implemented dollar cost averaging and bought on a weekly basis, your average cost of buying Bitcoin would have been a lot lower than its previous peaks, which some of you may have purchased. And this is a real beginner issue for any beginner watching investing in the stock market. A lot of them have some capital or cash that they're ready to invest, but it's easy to put that in, and it's a risky move to put that all in at once. So as a beginner, starting in the stock market and investing, dollar cost averaging works brilliantly. So it allows you to test the market, get an understanding for how the price point, what is the price action of a particular equity or stock or cryptocurrency, and it allows you to remove the emotion from your investments that you make into the market. Personally, this is how I started. I wasn't picking stocks. I wasn't glued to charts. I just invested on autopilot week after week. And the crazy part is over time, I built a six-figure portfolio without even noticing. The money just grew quietly in the background. Dollar cost averaging is the exact strategy that made me rich. No predictions, no stress, no, just simple consistency. If you want to build wealth the same way, this is how you guys can do it. And if you want me to actually show you my own dollar cost averaging portfolio in real time, make sure you subscribe because that's what I'll reveal in my next video. Remember, invest consistently, get rich slowly, and let time do the work. Before I let you guys go, another area of what I'm actually trying to build for my subscribers and as I build a community is a tool which allows investors to find um, actual low value stocks. Now, instead of following the hype, instead of finding stocks that are hyped and trending, I am trying to create a tool which simply acts as a screener to allow my subscribers to find undervalued stocks. So this is a tool which is work in progress. I'm creating it and it is going to be released soon. If you are interested in these tools or anything like these tools, please feel free to subscribe. I will be issuing the free version for my new subscribers and my early subscribers. So stay tuned, do subscribe, and comment down below if you want to understand or learn any more about investing in the stock market. So thank you guys for watching. I will catch you guys on the next video. Take care. Goodbye.